Good afternoon and welcome back. This is US Home Talk. We are live here every Wednesday at noon and on demand at ushometalk.com or anywhere that you find your podcasts. I'm your host, Mike Overson, with Luminate Home Loans, producing branch manager in Savage, Minnesota. On the show with us today, another host is Jason Walgrave, Mr. Spray Tan with Walgrave Real Estate Group and the Minnesota Real Estate Team at RE/MAX Advantage Plus. And we also have Marcus Walgrave in Sioux Falls, South Dakota. He is with Hague Realtors. Good afternoon, gentlemen.
And I need a tan.
Yeah. We have Jason who's definitely got the tan going, and Marcus who needs the tan, and then you got me right in the middle. I'm kind of just the best of both worlds there. Is that what we're going with for today?
That's
fair.
Where we're at.
Yeah, that's fair.
Well, I will say that I looked like Marcus 3 days ago, but over the weekend I was outside shoveling about 4,000 pounds of rock and hand digging holes to plant arborvitaes in. And so now I have I worked on my tan while I was doing that in our 97 degree heat, and got a little tan going here. So what did you guys do over the long weekend?
I had a great weekend. It was pretty relaxing. Spent quite a bit of time on the water and in the pool, and it was nice. It was a nice weekend. A great way to end the summer. Our kids all went back to school. Well, our youngest ones went back yesterday. Tay went back today. So they were all smiles first day of school. So that was a good thing.
That's good. That's good. Marcus, your kids started school. South Dakota starts earlier, right? They've already been in school for a couple of weeks.
They have been. Yeah. Let me see here. Let me look at the calendar. They started on the 17th.
Oh, wow.
Of August.
3 weeks ago.
So their summer ended weeks ago, but which is actually kind of nice, right? I mean, we did start early, and those first couple of weeks are always a lot, for the little kids, and we got to roll right into a Labor Day weekend, and 2 weeks into it, you kind of get this long holiday weekend break and kind of let them recharge and realize, now they're about ready to grind it out for the next 9 months.
Nice. And you guys get done. You guys get done in May though too. Then where we don't get done until the second week of June up here in Minnesota.
Yeah, we get done in May, and even if we have a couple like snow days, we're still done prior to Memorial Weekend. So again, it's like it kind of feels like a bummer when you do start in the middle of August but it is nice to know when you are done before Labor Day. It's frustrating when you know that you got a couple snow days and they're like, oh, by the way, after Labor Day, you got to come back for 2.5 more days. It's like, geez, come on. What are they going to learn in those 2.5 days?
Yeah.
Nothing.
Exactly.
Nothing.
Nothing. So I was talking to Chris Yarborough, who's on our team. Of course, Yarborough has been a guest on Minnesota Home Talk many times over the years. And so he's an avid hunter. And so this past weekend, he was out, Marcus, in your neck of the woods, or at least your state. He was in the Black Hills hunting. And I said, well, how was it? And he goes, it was the hottest I've ever been in my entire life. And I said, what was the temp? 116 degrees, because he's in the Badlands. That's where he was hunting.
Yeah.
And so, I mean,
not heat index. They probably hit 116.
The temp,
excluding heat index.
Yes. And so he said the amount of the water that he drank in a 3-day period was absurd. So today he was very happy because the cooler weather is coming through. So,
I mean, literally, that temperature basically got cut in half because it's only in the 60s today here, and he was almost all the way up to 120 out there.
Yeah, no
incredible.
kidding.
Might have been high 50s this morning. I think it was.
Was it?
Right before sunrise. I think it was like high 50s in the Sioux Falls area. So, cut in half, like literally.
Crazy.
Big swing.
So that's our Midwest weather there for you, though. I mean, we're used to that, right? 30. I mean, we literally cooled off. If you rewind 24 hours from right now, we were at 97 degrees. Mm-hmm. Right now, we're at 64 degrees.
Love it.
So That's
Love it.
that's how it goes here. Our topic for today, we're going to talk about which loan is right for you. Okay, which home loan is right for you. And there's nothing more exciting than talking about mortgage financing on Wednesdays at noon, right? This is going to be a very exciting topic. You're going to hold on to the edges of your seat. Make sure you stay down and seated for this one. So we're going to talk about conventional loans, FHA loans, VA loans, and USDA loans. We might brush on jumbos a little bit. Jumbos are kind of like another beast, right? They're kind of on their own planet, if you will. Things are completely different with them. But I broke it down into like five different areas. So we're going to talk about how the rates differ on each one. We're going to talk about how the costs are different on each one. We're going to talk about how the appraisals work for each loan type. We're going to talk about any sort of restrictions that they have. And then we're going to talk about a big one in today's world, and the big one that's been, I guess it's been big for the last few years, is seller's choice. You know, what is a seller going to accept first on an offer as far as the type of loan that you're doing? So let's dive right in here, fellas, and you can feel free, obviously, to join our conversation here. You can go and call us live on our real estate hotline during the show here, and we'll take those calls and those text messages, and we'll answer those questions live on air. 612-234-7585. Again, 612-234-7585. Or you can also go into the comment section if you're on Facebook watching there. Or if there's any sort of comment section on where you're watching at, just type in your question into that comment section, and we'll answer those questions live during the show here as well. Okay, so let's talk about rates. So let's start with conventional loans. So conventional loan rates are going to differ the most out of any of those loan products. The reason why is because conventional loan rates are highly rated upon credit score. They also have like benefits for loan amounts. So the lower the loan amount, you get interest rate reductions. Super high loan amounts, you get interest rate reductions. And then income level too, because there's programs, conventional programs out there. If you're underneath a certain income level, which is typically 80% of the area median income for the market you're in. So the Twin Cities market up here, 80% of the area median income is $99,440. Sioux Falls area, if I had a guess, 80% is probably in the 78 to 82 range, maybe 84,000, somewhere in there. So it's going to depend on which market you're in. But you get interest rate reductions and mortgage insurance reductions if you're underneath those income levels. So depending upon, let's say you got a credit score, you got a low credit score, and you're over the income limit for this particular program that gives you reduced interest rates and things like that, you could easily be at, around 8% today on that interest rate. If you have a high credit score and you're underneath the income level for your particular area, you could easily be in the high sixes today.
Wow.
Right? So a big range. FHA doesn't range as much. They don't have, hey, if you're underneath this income level, we're going to give you a break on your interest rate, or their interest rates don't move as much based on credit score. So a 660 credit score and a 700 credit score is probably going to give you pretty close to the same interest rate, because they're just not going to move their rates much as far as credit scores go. In general, FHA rates are a little bit lower than conventionals. So same credit score, same down payment amount, this and that. FHA is probably going to be a little bit lower as far as interest rate goes.
When you say a little bit lower, Mike, do you mean an eighth of a point or quarter of a point, or
eighth to a quarter? It's not going to really move the dial much. No.
Okay.
Let's talk about VA loans then too. So VA loans in general typically have the lowest rates on them. Okay. So, again, they're kind of like FHA, where they're not going to swing their interest rates a big amount based on credit score. So a 750 credit score versus a 650 credit score in VA, you're not going to see a big wide range as far as interest rates go between those two credit scores. Maybe like a quarter to 0.3%. Where on a conventional loan, if you're comparing a 750 versus a 650, I mean, you could be a full percent difference between those two.
Interesting.
USDA
VA
loans. Oh, go ahead.
VA loans, Mike. Got a question on that. So I was talking to a guy last week, and he was talking about VA loans having additional exceptions available for folks that might not qualify for an FHA or conventional. And so I think, can you talk a little bit about the different benefits or exceptions that a VA loan might have that other loan programs, don't have?
Yeah. So the VA loan, they work. So one of the differences between them that I see a lot is how they calculate student loan payments. A lot of people have deferred student loans where on their credit report it shows a 0 monthly payment. So eventually you're going to have to make some sort of payment on there. So mortgage lenders are going to say, hey, we got to account for some sort of monthly payment that's going to come up on these student loans to make sure that when these student loan payments hit, you can actually afford to make the student loan payments and keep on making your house payment.
Sure.
So the VA loan actually has the lowest monthly payment calculation between all the loan programs. So that's one area where they kind of excel. They're not going to hit you so hard on those deferred student monthly payments for qualifying purposes.
Sure.
And the VA, when it comes to exceptions, the VA, they want to give loans out to the veterans, right? So they're very relaxed on certain things. So if you have a funky situation, you had a previous foreclosure or a short sale or something like that, their waiting periods after a foreclosure and after a short sale or after a bankruptcy are actually the shortest out of any loan program that's out there as well. So, and everyone's situation is different. When it comes to exceptions, it could be an exception for everything. You don't have the job history needed. You're a month and a half short of the job history that's required for it. Or, you're short here, you're off there a little bit. Writing letters of explanation as to, what caused you to be short in that particular area and what you have done to correct it kind of goes a long way as far as underwriting goes to be able to get over that hurdle and get around, where you might be short.
I think that's a great. Go ahead, Marcus.
I was going to say, Mike, when you talk about the VA loans, it's a veterans affair. Are we talking about just veterans, or is it anybody who is active duty as well?
So active duty and retired vets are eligible. Now there's eligibility requirements for each one. So there's a page on the VA website. So if you just type in VA home loan eligibility requirements, it'll be one of the first things that pops up. And it's different for active duty versus retired veterans. And so you'd have to go in there and look to see if you meet those eligibility requirements, based on what you find on that website.
But ultimately, if you do qualify, the product, it would be, in a sense, the same. If you're comparing apples to apples,
yeah. Yeah. So if you qualify for a VA loan, the VA loan is universal and applies to everyone who is eligible for it. Mm-hmm. It's not going to be different for, a retired veteran versus, someone who's active duty.
Yeah. So I think what's important for folks to understand is, a lot of times you'll do research online and you'll go in this example, going to the VA website and reading the eligibility requirements. But if you don't meet those requirements, that's why it's so important to, call a top loan officer like Mike Overson and his team, right? Because there can be exceptions to the requirements. There can be exceptions based on your individual situation or circumstance. So, aligning yourself with a top mortgage professional is so important. Not only just because you want to get the loan done, but so that you understand what the requirements are, and that there might be exceptions to those requirements. I mean, Mike, one of the many things that I've been impressed with you and your team over the years is that you and your team have the ability to get deals to the finish line that other loan officers weren't able to do. And that can be a number of reasons. Maybe they're inexperienced, or, maybe they just want to work on easy deals, or, but I mean, you've helped out so many of our clients over the years that have been told, no, you don't qualify for a loan, or no, we can't help you, or no, you can't do this, or, you can't do that. And you do a deep dive into that individual situation, and you're finding, exceptions, or you're finding, rules that many don't, or most loan officers don't know about. And so it's just, it's so incredible when someone comes to us, they've been turned down by, somebody, to buy a home or to get a loan. We send them over to you, you go through it, and you're like, actually, you know what? I think there's a way we can get this done. Let's really dive in. Now, that takes longer. And it certainly takes a whole lot of experience to be able to navigate through those deals. But it is, man, it's a great feeling when you're sitting at that closing table with a client when they're buying a home that they, 6 months ago were told that they can't buy a house. They don't get to buy a house. So
Right.
it's an awesome feeling.
Yeah, the analogy I use, it's a loan is like a puzzle, right? If it's an easy loan, it's one of those 6-piece or 8-piece puzzles that your 3-year-old can put together, right? Very easy. The shapes are big, they're not too complex, right? You get these 6 or 8 pieces together, you got your loan put together, right? And you're going to the closing table. Some of these loans are 1,000-piece puzzle, right? Get all these moving parts, the shapes, almost every single one almost looks identical, right? And it's like, man, how am I going to fit this in, and where does this one go, and this and that? So the complexity of a loan file, some of them are 1,000-piece, puzzle that we got to put together. Most of the time, you can put it together to say, look, we can get this done for you, and here's what it's going to take, and there's lots of steps. Sometimes it's like, look, we can't put this together for you, and this is where we're short, but this is how you address those items. So I need you to do this, this, and that. And then now you have a plan put together with that person that you can execute on. And then down the road, they should be in position so you can get them approved.
Yeah. And you've talked about that for years, Mike. It's like, look, if you want to a home loan, if you want a mortgage to buy real estate, I can get that for you, period. Now, that might take a plan that you have to follow, consumer or buyer, and it might take some time to get to that goal. But with a plan and some time, I don't think you've met anyone yet that you couldn't build that plan to get them that loan.
Yep, it's true. And it's one of those things. Some loan officers want to take the time to do that, and some don't. But that's what we do here. Once I can see that puzzle and I look at the different moving pieces, it's easy to put a plan together to say, hey, we're good over here, but we're short over there. This is what needs to be done, and we move forward. So,
yep.
All right.
You kind of look at that online searching, right, Mike? And you kind of mentioned about hopping on and seeing the VA home loan. Just do a simple web search of that. It's going to give you some of the criterias. But that's one of those deals where, just because you see something, be like, well, I don't qualify for that. Don't get discouraged and just count yourself out. Say, oh, well, then, it's not for me. Or the idea of looking at something and be like, okay, well, ideally you want to have this credit score. It doesn't even use the word ideally. It usually just says, this is the credit score that you want. And then people sit back and they're like, okay, well, I need to start working on my credit score and getting those things done. But, instead of just trying to figure out on your own, reaching out to somebody like Mike and coming up with a plan like Jason was saying, maybe it isn't, maybe you only need to pay off one credit card balance. Or I know, like we talked earlier in this year, Mike, about, well, hold on, let's actually keep a balance. Let's keep that balance at 20% or 35% of whatever the max is, because that'll actually will improve your credit score more so than if you just had a zero balance. So it's obviously really good that we can get a lot of information online, but don't stop there. I mean, if you're interested in getting a home loan, if you're interested in buying real estate, align yourself with the right people.
Absolutely. So USDA was the last loan type here as far as rates go. USDA is one of those loan programs that's kind of restrictive. When I say restrictive, the house has to be sitting in an eligible area. So the house you're going to buy has to sit in a USDA eligible area. It's a rural development loan, so you got to be outside of metro areas in order to do this. So the USDA loan out of these 4 loan types is probably the least used one, just because it has those geographical restrictions on it. But the interest rates are really good on them. Interest rates are down there around FHA and VA levels for the most part. So it's a great program if you are out in a rural type of area buying a house out there. It does really good. It's very competitive as far as interest rates go. Okay, so let's talk about costs. Okay, so each one of these loans has, well, let's do this. Let's see if you guys know. Okay. Out of the 4 loans, conventional, FHA, VA, and USDA, which of these loans has what's called a funding fee? which is like an additional fee that you have to pay, a one-time fee you pay at the time of closing to get it?
VA.
VA. Is
Evan?
it the first answer? Do I gotta?
No.
Chime
I said
in on
Evan,
like
you want
a-
to take a guess? Which of the loans?
Yeah.
It could be
VA.
one, it could be all of them. So you got to pick out of the four.
We don't got
No
Evan.
guesses? Okay.
VA.
Nah. I mean, everyone's saying VA, so I'll just play the game and say USDA, even
Okay.
though I think that's incorrect.
Okay. So the conventional loan is the only loan that doesn't have some sort of one-time funding fee that you have to pay at closing. FHA, VA, and USDA all have an additional funding fee you have to pay in order to get that loan at closing. So the conventional loan is the only one that does not have an additional fee to get. Now, in most cases, actually in all cases, they'll let you finance that fee into the loan amount. So on a VA loan, right? Let's say it's let's say you've used a VA loan in the past to purchase your first house. You've sold that house. Now you want to use a VA loan now to purchase your next house. And you're a vet that is not exempt from paying the funding fee, meaning that you have to pay this funding fee. On the second house, you're going to pay, depending on your down payment amount, you're going to pay 3.3% of your loan amount in a funding fee. So if it's a $200,000 loan amount, you're going to pay a one-time fee for that second use of the VA loan of $6,600 in order to use that VA loan. Can get kind of expensive, right? So that's the VA. It ranges. FHA is 1.75% of the loan amount. USDA is 1%. So again, they do a favor for you and they let you finance it into the loan amount. So on a VA loan, if you're going to do zero down on a VA loan, your starting loan amount would be higher than what your actual purchase price of the house is because they're going to roll that funding fee on top of it. So if you're buying a $200,000 house doing zero down and it's your second time using a VA loan, and you got to pay that funding fee, you're going to start off with a loan amount of $2,066 on a $200,000 house because that funding fee got rolled in on top.
Interesting.
So
Mike, if you're a disabled veteran,
yes,
do you still have that fee?
most of the time you're exempt from paying the fee, which means you don't have to pay that fee. So when I'm speaking with anyone who's going to do a VA loan, that's one of the first questions I have on my list up front is, first of all, do you know if you are eligible for a VA loan? Most people that are eligible do know. It's like, yep, I'm eligible for VA loan. I know for a fact. Okay, great. Now, do you know, are you exempt from paying the funding fee or do you have to pay that? Most people don't know that. Some do, but most people don't. And that's when we can easily I can get their DD 214 and we can actually order what's called a certificate of eligibility for them on the back end. And that certificate of eligibility says if they have to pay that fee or not. So
now, Jason, I know you do a lot of business in new construction. I think that's something that in my earlier years of my career we ran into and Mike, you can obviously add to this as well. But veterans, if you're looking to purchase new construction, there are some extra additional items that maybe the builder needs to do if they haven't already done so.
Yep, that is correct. FHA too. If you're doing FHA in new construction, there's additional stuff that we need from the builder, additional forms they got to fill out and things like that in order to do an FHA loan on new construction. So as far as costs go, so the conventional loan then has the lowest costs out of all four, just because it's the only loan that does not have that additional fee that you need to pay. Now, VA loan, again, if you're exempt from paying that, you don't have to pay that, so that becomes an even playing field at that point. All right, let's talk about appraisals and how appraisals are different, right? So two of the loan types work similar to each other, and then the other two work similar to each other. When I'm talking about appraisals on here, I'm talking about, does the appraisal stick to the house or not? So on the conventional loan and the USDA loan, those appraisals don't stick to the house, meaning that if you have buyer number one come to a house and they're going to make a conventional loan offer on that house and they get an appraisal done, right? Let's say that deal falls through for whatever reason, right? Something comes up and that deal doesn't close, and buyer number two now comes to buy that house, and that buyer number two is doing a conventional loan. Buyer number two gets their own appraisal. You can order a brand new appraisal with buyer number two, and you don't have to use appraisal number one from the first buyer. Now let's talk about like an FHA loan and a VA loan. So they work a little bit differently. FHA buyer comes to a house, gets an FHA appraisal done on that house. Okay, and let's say that deal falls through. Buyer number two is also going to do an FHA loan on that house. Buyer number two has to use the appraisal from buyer number one for 4 months. Okay, so that first appraisal, that first FHA appraisal is going to stick to the house for 120 days. And any future FHA buyers that try to buy that house in the next 120 days has to use that first appraisal that was done.
Does the second buyer have to pay for an additional appraisal?
Typically the appraisal's already been paid for. So no, they a lot of times then don't have to pay for it because buyer number one paid for the appraisal, and usually they pay for it up front, which means, I already paid for it. It's done. I wasn't able to close for whatever reason, lost a job or, whatever. Yeah. So that second buyer kind of gets a nice little present from buyer number one. Here's a free appraisal for you.
Thank you, buyer one.
Yeah.
Yeah, right. Does the appraisal report just kind of go into like the appraisal report cloud, or is there a destination where these mortgage bankers can get this from? I mean, there's got to be some sort of data sharing base. Yeah,
FHA has a website. It's called FHA Connection, where all this stuff is logged, right? FHA case numbers, appraisals, all that stuff. So if we're doing an FHA loan for someone, we got to log in FHA Connection, right? We type in borrower's name, social, we type in the address, all this stuff, and it pulls up the history of everything that's been done on that house. And so if we can see that there's an existing appraisal that has been done on that house in the last 120 days, now we got to reach out to the lender that ordered that appraisal and have that lender transfer that appraisal over to us.
Awesome.
So the VA works the same way, but they're up to 6 months now. So 180 days is what you got to use that first appraisal on. The conventional loan, the USDA loan, they don't have that. They don't have that deal. So if buyer number two will just order their own appraisal and gets to use that second appraisal, wherever it comes in at.
So as a seller and as a listing agent, so here's the example. You've got a house, and let's say you're really pushing the value. You might even have it, overpriced because maybe it's a super desired neighborhood, and you're probably going to get the price even though it's higher than what it's worth, higher than what the market value is. You have to keep that in mind as a seller. If you accept a VA or an FHA offer, and a part of that offer, if I'm the listing agent, I'm going to probably want some type of appraisal gap guarantee in there, because if you don't have the gap guarantee in there and the offer is contingent on the financing's contingent on the appraisal. If the appraisal comes in low, the buyer does not have the ability to get financed any longer. That appraisal now is stuck to your property, and the value is going to be stuck to your property. So you're going to have to keep that in mind. And so these are things that, a top listing agent will talk to with sellers if you've got multiple offers. Maybe if you're in that scenario where you think that the price or the purchase agreement is higher than what the value may come in at through the appraisal, maybe you consider taking a lower price conventional offer, because you're not going to have an appraisal sticking to it if that's a possibility. So all things to consider when you're looking at the offer and looking at the financing specifically.
Yeah, there's a lot of moving parts that experienced real estate agent will bring up to their sellers to say, the number on this offer looks great, right? Highest offer price on here. Here's where this thing can go sideways, right? And then so then it's a matter of, do the benefits outweigh the risk as far as this thing turning sideways potentially? Right. Less experienced agents probably aren't going to have the knowledge in order to explain that effectively to their listing agents, and then might get caught down the road a little bit, after you've already accepted an offer.
Yep.
So let's go. So that was appraisals. So FHA, so we covered all that. Let's cover restrictions on the two. Okay. So let's go through restrictions. USDA, we kind of spoke about this already. It's restricted to rural areas only. There is a map that you can go online. So if you just go to the USDA .gov, you can work your way to find the eligibility map, and you'll pull it up and it'll be like, okay, these shaded areas are not eligible for USDA financing, and then the non-shaded areas are. So you can actually type in a physical address on there. So if it's right on the line and you're like, ooh, I don't know if that one is eligible or not, type in the address, boom, it'll say eligible or not eligible. So that's a restriction of USDA. It's got, the house itself has to sit in a in a eligible area. VA loans, we kind of spoke about that already. Obviously, the borrower has to be eligible for a VA loan. Okay. FHA, any restrictions there? When you're buying a condo, so condos have to have a special FHA approval in order for you to do an FHA loan on them. The VA loan also requires the condo association to have a special VA approval on it before you can do a VA loan on a condo. So when we're looking at properties with our clients, I know we have a bunch up here that the property looks like a townhouse, feels like a townhouse, listed as a townhouse. It's technically a condo, right? So an experienced loan officer is going to be like, all right, so now this buyer wants, this FHA buyer wants me to send a pre-approval letter on this townhouse. I got to go in and figure out, is it actual townhouse or is it a condo? And if it's legally a condo, now I got to look on FHA's website to see, is this condo association approved for FHA financing or not? If it's not, can't send out the pre-approval letter. If it is, I can. So again, that's where the kind of the experience comes in, because a lot of loan officers are just be like, oh, it's a townhouse. The listing says it's a townhouse. Send it out. You get 3 weeks down the road when someone who knows what they're doing gets the file, such as the underwriter, and says, hey, this is actually a condo and this association is not approved for FHA financing. Deal falls dead. So,
and that's something too, where, can you get a condo that is not FHA approved? The answer, yes, you can. Is it likely that you're going to be able to convince the HOA board to do the proper paperwork to get it approved in that amount of time? Not likely. So, is it like a guaranteed deal breaker? Not necessarily. But very, very likely it's a dead deal.
So a little known fact here. So FHA used to have what's called a spot approval. So spot approval back in the day was, all right, I want to buy this condo, just this one unit in this condo association. FHA, it doesn't have its FHA approval, but I can actually work with the association to collect the right documents, and I can approve just this single unit, right, for FHA financing. It doesn't approve the entire association for financing for FHA. It just approves that one particular unit. We used to do that back in the day, and then FHA took that away, right? So then it's like, okay, either the entire association is approved for FHA or the entire association is not. Now, about a year and a half ago, FHA brought the spot approval back, and I've done a couple of them. So now if I look and see, okay, yep, it's a condo, know that the association doesn't have their FHA approval, I can do a spot approval now, okay? But we have to collect all the financial information from the association, and we got to send that to FHA to get it approved. It's not quick. It's not easy, right? And typically you have to make your offer and get your offer accepted, and then we're going to be working through that process, and we won't actually find out if we can do an FHA loan on that until maybe, 2 weeks after you have signed your offer and moving forward on it. So that's a conversation where we have, it's like, look, as long as the association financially is sound, we'll be able to do the spot approval for you. But if the association is not financially sound and it doesn't meet FHA's requirements, we could get 2 weeks down the road, find out that it's not qualified, and now we can't do this FHA loan for you.
Sure.
So anyway, so goofy restrictions. So that's why I brought that up as the condo thing there. Obviously, VA, you got to be eligible for a VA loan. USDA, it's got to be in an eligible area. Conventional, kind of universal, right? It has the least amount of restrictions through all the different loan programs that we're talking about. Let's talk about seller's choice. Okay, got a seller. Okay, let's just say it's your single family house right in your bread and butter price point. Let's say it's $350,000. You got a seller there. Highly, great school district. It's got checks all the boxes, and we got 20 offers on this listing. And it's a mix of conventional FHA, VA, and USDA offers. Let's just say it's right on the outskirts of town and it's eligible for USDA, right? So we got offers with all 4 different loan types on there. You guys, Mr. and Mr. Agent there, what are sellers going to look at first? What type of offer?
Conventional.
Cash.
I
Who's got
suppose,
the cash offer?
Cash first, yeah.
Cash over list
cheating.
price, no inspection, close in 10 days.
Have you guys ever got
Free rent
like
back for 60 days.
Have you ever guys got a picture with a cash offer of like the guy who's got like hundreds folded out, like fanned out, just
That's a good
fanning
idea.
himself with hundreds? There's my
That
cash
is a good
offer. No.
idea. No.
Or a
Yeah, so
suitcase.
cash is usually king, right? Cash is usually king, but let's just say there's no cash offers on the table and it's finance. What do you guys, what as listing agents, what are you advising your clients to take?
Well, I mean, we're going to look at all the terms of the offer, but it's assuming all the terms are the same, including price, we're going to go with the conventional.
Marcus, is that what you see in Sioux Falls too?
Yeah. I think one thing to also kind of keep in mind as well, right? I mean, it's some additional factors to it, terms, but also kind of getting a good understanding of the seller's property. I mean, if the seller's property is locked and loaded, and maybe this FHA loan is $20,000 better than a conventional loan, and they have an appraisal gap coverage that's going to cover this $20,000, and they got this buyer has a lot of additional things, but for whatever reason, they're seeing a benefit of taking an FHA loan. I mean, but I think like Jason said, I mean, 19 out of 20 times it's going to be that conventional loan, if given the option.
Yep, and why is that? So explain why a seller's gonna be like, I'm gonna take that conventional offer. So let's say the terms are the same, right? $350,000 offer, so they're offering $350,000. They're netting the seller the exact same amount. Closing date's the same amount of days on their inspection, or maybe they're both waiving inspections, things like that. Literally, it's identical. The only difference is conventional versus FHA. Additional reasons why conventional is going to get picked first.
Yeah, I think one of the bigger reasons is the appraisal. I think that FHA and VA appraisals have been a little stricter than conventional appraisals over the years, as far as things that work orders that might be called out. I think that consumers in general are more familiar with conventional loans because there's been more conventional loans done, and they may have a conventional loan themselves. And so, and then there's, there's more, we've all heard more horror stories about, a VA loan that, that didn't go through because of, maybe something in the appraisal. Generally, conventional loans are going to have, generally more cash down. So, if FHA is 3.5% down and VA is 0% down, and a conventional deal, they usually start at 5. You can go to 3, but usually start at 5% down. It can be as much as 20% down. Well, a seller, they want the buyer that's got more skin in the game, right? And so if you've got a buyer that's putting more cash down, you've got financing that will have an appraisal that is likely going to have less potential issues than FHA or VA could, they're going to go with a conventional deal. And if there's no appraisal that sticks with it either for 4 to 6 months.
Yeah, the work order thing comes up, just to expand on the appraisal things. So FHA and VA loans have a little bit tighter requirements as far as the property condition. If you have a house that's right, it's in great shape, there's nothing wrong with it, it's new or whatever the case may be, you got no issues, you got no concerns getting a VA or an FHA appraisal done on there. The only thing there would be the value, right? So if the value comes in underneath the purchase price, it sticks to the house for the next FHA or VA buyer. Conventional is just looser. Classic example is chipping and peeling paint. Conventional loan goes out there, maybe you got some wood siding that's got a little chipping or peeling paint, or maybe got some boards on the deck that have some chipping or peeling paint in there. Conventional's not going to bat an eye at that. They're going to let that slide. They're not going to require that to be fixed or addressed. FHA and VA, they're big on chipping and peeling paint because of lead paint that could be there. A kid could come by, peel it off, eat it, have health issues. And so chipping and peeling paint on siding or decks or anything like that, or even on the detached garage, FHA and VA are gonna require that to be scraped, and the paint chips cleaned up and stuff like that, and then repainted so there's no exposed wood.
Yep.
So that's a classic example.
I think the seller likes to follow the leader, right? The mortgager. If the mortgager says hello, mortgagee, you can buy this house with less restrictions attached to it because of your financial position, your credit score, cash assets, etc. A seller's going to say, well, I want that. I want that buyer for my property. If the mortgager is more confident in this individual than this individual, well, I want to have the peace of mind of increasing my probability of getting to the closing table. So it's kind of that the seller simply just looks at it and say, okay, well, who does the mortgager feel like is the better buyer of my house, and kind of defaulting to that conventional loan buyer.
Yeah, good points there. We actually had a question come in here. So Justin submitted a question. What are your thoughts on buy downs? It's a great question because we talk about it almost every single day, right? We talk about it every single day on, builders are offering money towards, interest rate buy downs. And, if you're getting any sort of seller pays, if the seller's giving you some concessions, you can use that to pay closing costs or buy a rate down. And so thoughts on buy downs? Jason, let's start with you. What's your thoughts on buy downs?
Well, I think they can be a great tool to buy that rate down. Because we've got rates higher than they were a year ago, and you've got rate shock for a lot of folks. You can and you've got builders and sellers now that are willing to contribute toward buying that rate down. So I think that it's important to look at the different options. And the different rate buy down options that are out there, whether you're talking about a 2-1 or a 3-2-1, or maybe a permanent buy down, and understanding what that means. There's some of the buy down programs where if you buy the rate down now and then 6 months from now the fixed rates go down and you refinance out, well, then you get that money back. There's others where you don't, and so it can be a great way to really become more comfortable with what your payments are by buying that rate down. I think they're great.
Shout out to Justin Oakland. He's a good builder developer in the Sioux Falls area. So thanks for the question, Justin. I'm sure you probably come across it as a builder. We've been seeing that a lot in our market in terms of marketing pieces by our builders, to entice the buyers out there to work with them. So.
Yeah. So buy downs, buy downs are, there's two thoughts, right? It's like, do I put a bunch of money into buying my rate down right now? So when you do a permanent rate buy down, you're basically paying a one-time fee at the time of closing in exchange for a lower interest rate on the back end. So you got to ask yourself, is it worth putting this amount of money in up front to get this lower interest rate? Pretty much everyone buying a house in today's market is thinking that they're going to probably be refinancing out of the loan that they're getting sometime in the next 24 months. So you got to run the numbers and say, okay, I'm going to pay this much extra at closing up front. I'm going to save this much on the back end. Am I going to refinance or recoup that money by the time I refinance the loan? Right. And so that's one of the calculations you got to go through. And it depends on what you believe is going to happen with interest rates. If you truly believe interest rates are going to come down soon enough to where you're going to be refinancing out of your initial loan before you would save the amount of money you're going to pay up front, well, then don't do the rate buy down. But if you think interest rates are going to stay where they're at now, and it's going to be longer, 4, 5, 6 years before interest rates come down to where you can refinance to something lower, well, then the buy down probably makes sense now. But the one area that a lot of people don't talk about is, what does a rate buy down do for your qualifications? Okay. I want to buy, I'm a buyer out there in the market. I want to buy a $450,000 house, but at the current interest rates, I'm only qualified for $400,000. How do I get qualified today for $450,000 so I can buy that house? Well, if you can buy your rate down, so typically 1% in a rate buy down is going to gain you 10% in purchasing power. So if your rate's 7% and you qualify for a $400,000 loan, well, if the rate is 6%, now I qualify for $440,000, right? So can I use a rate buy down to qualify for a higher purchase price to get me up to that next level house that I want to get into? Absolutely, you can. So that's another area where rate buy downs come in is, it's maybe not necessarily the monthly payment savings or whatever the case may be. It might be on the qualifying side of things where it's a tool used to get those people into the house that they actually want to get.
Yep.
So, and that's what a lot of builders are doing, right? Buy new construction, because guess what? We might have an incentive. We might pay for some of the rate buy downs, right? To make this interest rate on this house lower, more affordable for you so you can qualify. I mean, there's a bunch of different ways to skin that cat there. Whereas if you go out into the existing market, you're probably going to be competing with other buyers. And then are you going to be getting any contribution from the seller to help, do a rate buy down in an existing market when you're competing against other buyers out there?
Right.
Probably not. So that's why a lot of new construction, you're going to see some sort of buy down or rate incentive on that, because builders are certainly seem to be willing now to help out on that side of the coin.
Yep.
So it was a great question. Thanks, Justin.
You kind of look at that crystal ball too, and that's okay. Well, the concept of like, well, we want to in the next 24 months refinance into this hopefully better interest rate. It's like, okay, well, if that scenario doesn't play out, if interest rates don't get better, it's like, okay, well, if they don't get better, then that's likely meaning that the values of homes are going to continue to rise, and so then but you're still in a better position by buying today. Even if you don't get the opportunity to refinance in 2 years, because the rates are higher, it's like, well, the only reason why the rates would go higher, or likely one of the major reasons why rates would go higher, is that the value of homes continue to rising. So then it's like, okay, well, if you thought you could buy now and then in 2 years, or buy it in 2 years from now, and homes are more expensive and the rates are rates are higher, it's like, well, you're way out ahead, even though you didn't get that chance to refinance. So it's not like the idea of like, hey, this is a do or die refinance in 24 months. If the market doesn't give you that opportunity, it probably means that the value of your home is doing pretty well.
Yeah. We talk about it all the time. There's really two costs to buy a house. It's the cost of the house itself and the cost of the financing to get the house. Unless you're paying cash, right? Then obviously the financing piece goes away. But we all truly believe if you buy a house today, or if you wait 12 months, you're going to pay more for that same house 12 months from now. Interest rates, they kind of come and go. It's a little less predictable. Inventory, supply and demand, that really runs what home prices are going to do. Supply is super low right now. Demand has always been high, especially in our markets up here where we're at in the Minneapolis market and Sioux Falls. Growing metro areas, right? Growing fast. There's lots of demand out there and our supply is low. So what's going to happen to home prices? Even if interest rates go up higher than where they're at now, home prices are going to continue to go up higher because of that demand, and the low supply. So if you buy today, you're going to get a better price for that house. When rates do eventually go down, which they will, it's cyclical, they will go down. Then you refinance at a lower rate. Now you got the best of both worlds.
Yep.
So, well, gentlemen, thanks for joining us today. So as our show comes to the end this week, we want to thank everyone for tuning in live and catching the podcast at a later time. You can find us anytime wherever you find your podcasts and on our website, ushometalk.com. We are here to help with all of your real estate and financing needs here in Minnesota, South Dakota, and the entire United States. I'm Mike Overson, and on behalf of Jason Walgrave and Marcus Walgrave, we're going to sign off, and we want you guys to have a great week.